Hey guys, we're going to talk about notes payable. Now, notes payable is going to act just like accounts payable, except for you're going to pay it back with interest. So you see here on November 1st, we borrowed cash and signed a notes payable. The note was for $10,000, 6% interest, and it's a 3-month note. So our journal entry is going to be a debit to cash because we borrowed this cash, which is $10,000, and we'll credit an account called Notes Payable. And this Notes Payable is a liability account, and we'll put that on our books at $10,000, and we'll debit cash for $10,000. Now, I want you to look at this terminology. The face amount of the note is the amount that we borrowed, so that would be $10,000. The total interest to be paid on this note is 3 months worth of interest charged at a 6% interest rate. So here's how you're going to calculate the total interest due. You're going to say 10,000 times 0.06 times 3, because it's a 3-month note, divided by 12. Interest rates are always given for a yearly amount, so if it's less than a year, you have to divide it by 12. Now, if your accounting textbook uses days, you may have to divide it by 365. Some accounting textbooks divide it by 360. And so you need to check your accounting textbook to see how to calculate the interest on the note if it's written in number of days, like a 90-day note, okay? So here it's a month note, so we know that we'll just say 3 divided by 12. So once again, the total interest paid is the 10,000 times 0.06 times 3/12 equals $150 that we're going to pay when we pay this money back. So maturity value is what we're going to pay back at the due date. So maturity value is the face amount plus the interest amount. So for this note, the maturity value is $10,150. Okay, so now we're going to look at the December 31st transaction. Now, nothing is due on the note until the end of January, but on December 31st, we have to make adjusting entries, and that's when we bring all of our revenue and expense accounts up to date. So at this point, we have to ask, have we accrued any interest expense? Does that mean has an expense happened even though we haven't paid for it? And the answer is yes. We have accrued 2 months. We owe 2 months worth of interest expense. So what we'll do is we'll calculate that amount. Now, if you think about it, it's a 3-month note, and so we're going to accrue interest. We've already owed 2 months worth of interest, okay? So what you'll do is debit interest expense, and we're going to credit a new account called interest payable. Now, the way we're going to calculate this number is we can say 10,000 times 6% times 2 over 12, or since I've already calculated the full amount of interest is $150, I'm just going to take 2/3 of that, which will be $100, which is called accrued interest. And so that is going to go on the expense side. It's going to be called interest expense of $100, and there's a new liability account called interest payable for $100. So this year, at the end of the year, we can report $100 worth of interest expense on our income statement. January 31st is when the full payment is due for this notes payable. So whenever you pay off a notes payable, we're going to clear out that account. So we'll debit notes payable for $10,000. We'll debit interest payable for $100, and I'm going to skip a blank here. You'll see why. Because I'm going to credit cash. Well, I'm going to credit cash for the full amount due, which is $10,150. This journal entry is not complete because we need another debit. That debit represents the interest expense for year 2. $50 is the interest expense that we incurred between January 1st and January 31st. Now, at the end of year 1, all your revenues and all your expenses are closed out, so this will be gone at the end of year 1. So when this journal entry is posted on January 31st, we would have a debit to notes payable, a debit to interest payable, and that's going to zero out those 2 liability accounts. And then a debit to interest expense this year for $50 and a credit to cash of $10,150. And so if you want to see how much cash we have, the balance would be this plus this minus this. It's $2,850. So you see that we borrowed $10,000 and it cost us $150 to borrow that money. Hope this helps you understand accrued interest.